you've never invested money before, but it's something you want to start, or maybe you already started, but you want confirmation that you're going in the right direction, this video is for you. Real talk, I wish I had this video when I had my first few $100s to invest, because I ended up losing a lot of it. But that's why I want to spell it out for all of you very simply to show you your various options to get started with as little as $500, sometimes even less. I'm gonna explain 6 options that most beginner investors typically consider. Make sure you stick around to the end of the video. I am going to provide some guidance on how you can even pick one of the 6 options so that you can actually just get started and become an investor. Welcome back to my channel. I am Lissa, a personal finance expert and a certified financial planner who wants more people building abundance and confidence in life. If that's your vibe, make sure you subscribe. I said that in one video and now I feel like I gotta say it all the time. Now, quick disclaimer. This video is informational and educational in nature, and it's not intended as financial advice. Financial advice is essentially prescriptive advice, telling you what to do with your money and where to put your money, and that's not this. The reason I can't do that, and nobody on the internet can really do that, is because I do not know your individual financial situation. When it comes to investing, as you'll see later on in the video, it's gonna depend on your risk tolerance, your time horizon, and your strategy. Those things are important when you decide your approach. If you've struggled to understand investing before, I do suggest watching or bookmarking my other video, because that'll help you if this just feels like a brand new world for you. Number 1, index funds. Index funds in the version of mutual funds. Let's try to de-jargon that a little bit. So an index fund is a fund, and a fund is a big basket of investments. It's like, rather than buying a stock from one company, you are buying a bunch of companies at the same time. An index fund specifically is this basket of investments that tries to match a market index. For beginner purposes, a way you can think about a market index is a list of companies that the stock market or whatever market tracks. A popular one you might have heard of is the S&P 500. So what's on the S&P 500? There are 500 companies tracked on that list. So if you invest in an index fund that says it is based on the S&P 500, you can literally go in and see what those 500 companies are and what you would be investing in. So hopefully that explains funds, and specifically index funds, a little bit. It's basically a means of helping you diversify and invest in a lot of things at once versus just picking one investment, aka putting all your eggs in one basket. Rewinding a little bit, I said index funds in the form of mutual funds. When you think about funds, these investments that these investment companies put together, there are different ways to purchase them. There are different types, there are a lot of nuance to it. A mutual fund has a price that it's gonna cost today. So when you buy into that fund and you buy that basket of investments, you're gonna buy it and then you're gonna have it. It's not one of these things that you're meant to buy and sell within the same day, aka trading, because it has one price for the day, whatever it's valued at the end of the day. If you want to buy an index fund, like we said, these investments that track against this list, buying it through a mutual fund is one way to do that. For comparison, a different way to buy a version of an index fund is through what's called an ETF, an exchange traded fund. Spoiler alert, that's going to be number 2 on the list, so we'll cover that in a second. Let's quickly talk about what are the pros and cons of mutual funds. Here's why people like mutual funds. Diversification. Your risk isn't tied to one company like we mentioned earlier. Historically, when there are mutual funds that have been around for a long time, it's because they show strong long-term results if you hold the fund for many years. Mutual funds are also low maintenance, so it has a set it and forget it type of feel, especially if you're a beginner. You buy it and then you own it. Now, some downsides to mutual funds. Some index mutual funds have minimums. Sometimes these are $500, sometimes it's a few $1,000s, sometimes it's more. If all you have is $500 to get started with, your choices could be limited. Another downside of index funds is that not all of them are broad. Not all of them are gonna help you diversify in the way you might expect. There are some funds that are totally in just one niche, one sector, one industry. So even though you might own several companies and it's not just all in one specific company, you might not be diversified when it comes to industries. And again, that could be your strategy, but I'm bringing this up because for many beginners, they usually start broad because it helps reduce your risk. If this is an option you select, you would essentially need to open an investing account. Sometimes that means a workplace plan. Sometimes this could mean an IRA, an individual retirement account. And it could be a non-retirement account altogether. So the way to go about it is you transfer your money into that account and then pick a fund that you can purchase into. ETFs, exchange traded funds. Quick recap, funds are baskets of investments. Exchange traded funds is what it sounds like. It means you can buy and sell these funds on an exchange. So think about a stock. When you go to purchase an individual stock, you can buy it right now. You can sell it in 5 minutes if you wanted to. Some ETFs track against an index. So buying a specific ETF means you are invested in a bunch of companies. Here's why people like ETFs. Oftentimes they don't have minimums. So this can be great if you have $500 to invest, sometimes even $25 to invest. ETFs have made investing in funds very accessible to people, especially if you're starting out with lower amounts. ETFs can typically also have low fees, but that's for you to do your research to find out if the specific ETF you're buying into has a good expense ratio. ETFs are also great for this strategy of investing called dollar cost averaging, which is a strategy that some beginners like to do, which means regularly investing a fixed amount on a regular schedule. That could mean that this week you buy the ETF and it costs a lot, and next week you put the same amount into the same ETF, but you get it at a better price. Over time, the cost averages out. I didn't mention that earlier, but you can also do that with mutual funds. Downsides. There is what's called a bid-ask spread. This is a tiny trading cost. So there's a small gap between what buyers will pay, what you would bid for a certain investment, and what a seller wants for it. So when you trade, you pay a very tiny sliver of this. It's one of the ways these investment companies and brokerage firms make their money, which turn out to be a cost for you, the person who's investing. Buying ETFs, I already mentioned it, slightly different from the way that you would buy a mutual fund, but it requires opening an investment account, transferring some money into that account, and then purchasing the ETF. Option number 3 for beginners to get started, Robo Advisors. This is where it starts to get a little interesting. So the first two I mentioned, index mutual funds or ETFs, these are investments that you can go ahead and DIY, go find an account, open it, fund it, and then find something to buy. With Robo Advisors, the process is kind of similar, but the means of investing is different. So a robo-advisor is basically an automated service that builds a portfolio for you. Usually they will invest in exchange traded funds or other types of funds. It's more likely than not going to be a very diversified portfolio. But rather than you having to do any research, the platform will ask you about your goals, your time horizon, and your risk tolerance. Based on that and how much money you put in, it will invest that money for you. Another thing that robo-advisors will do is it will rebalance your portfolio for you. So a quick example of rebalancing is, let's say your target mix of investments is between stocks and bonds. 80% stocks, 20% bonds. Just an example. Over time, let's say your stocks do really well and your bonds don't. That means you're gonna have higher than 80% in stocks and lower than 20% in bonds. If 80-20 is your target, that's your goal, you would have to sell some things, move things around to make it 80-20 again. With robo-advisors, they rebalance for you to make sure that what you're invested in aligns with your goals and your time horizon. People like it because it's hands-off and it works very well for people who just have a few $100s to get started. The idea is that you keep putting more into it, but if you just want to try and get started, you can do that with very low amounts. People also like it because you are diversified from day one. Similar to the first two options, you're diversified when you're investing in funds. The added benefit of a robo-advisor, as opposed to trying to do it all yourself, is the rebalancing. Now, some downsides. There is a small advisory advisory fee. So what you're gonna learn once you start investing is there's fees here, fees there, fees everywhere. We talked about that bid-ask spread. I didn't even mention earlier about different fees for mutual funds. Just know that there are fees associated with buying and selling investments. Investing through a Robo Advisor, there's usually a small advisory fee. It can vary. You'll most common see something like 0.25% per year or somewhere around that. For comparison, when you're working with an actual human advisor, usually that fee is 1% or a little more. Another downside of why people might not pick a robo-advisor is limited customization. If you are the person who likes researching and wants to be invested in very specific things, you won't be able to handpick individual funds or stocks or whatever, because typically it's the robo-advisor that is the value they're offering as a service. They have their algorithms and they know how to invest for you. The upside is if you want to try both, you can do both. You could have a robo-advisor here and then you can try doing some DIY investing yourself. There are plenty that you can look up online. You would open your account, answer all the questions in onboarding, which is going to help determine what your portfolio is going to look like. You transfer money and then it invests for you. Number 4, another way to start investing is through bonds. In short, a bond is a type of investment. The way to think about it conceptually is it's like a loan that you're making to a government or a company. Think about a government that needs money for a big project in the city or the state, or a company that wants to grow. They need money. So they're saying, hey, we're going to issue these bonds because we want some investment money. We want to take your money. You're going to own this bond, and later on we'll pay you back. And in the meantime, we're going to pay you some interest as well, right? As a thank you for letting us borrow your money. That's the concept of how bonds work. So that's like the first level of a bond. Then there's the bond market where you can buy and sell bonds, or there are funds, like we mentioned earlier, that hold bonds in them. If you're a first-time investor just trying to wrap your head around all this, just know that similar to a stock, which is a financial asset, it's something you can invest in, there's also bonds. It's another financial asset that you can invest in. What they represent are two different things, but the concept is the same. You're buying an asset, you're hoping that it gives you value, it gives you a return. So I'm not going to go into the nitty-gritty of all the vocabulary when it comes to bonds because it is a lot of jargon, but I do want to quickly talk pros and cons. Reasons people like to buy bonds. They're usually steadier than stocks. If you follow any ticker, you'll see stocks can go up and down in value by the second. So people like bonds often because the ups and downs aren't as big. People also like them because they do provide income through interest payments. On the flip side, some stocks do pay dividends, but some don't. Some are purely there because you hope that the stock is going to gain value. With bonds, you get some income through interest. Now, the big downside. Over long periods, typically, the returns you can expect from bonds are lower than stocks. So that's why often people are in both asset classes, because some of your money is used in riskier things because you want the potential to grow, whereas other things are there to kind of hedge your bets, to make sure you have investments that are less likely to lose value, but also less likely to grow considerably. There are different ways to invest in bonds. Similarly, it might require opening up an investment account, fund it, and you would look for bonds or bond funds. There are different nuances to different types of bonds. Number 5, money market funds. What is a money market fund? A money market fund is a mutual fund. Quick recap, going back to earlier in the video, a basket, a collection of investments. So a money market fund specifically is a fund, like an investment fund through an investment company, where they put money into many short-term, higher quality loans to more reliable borrowers. So think US government or highly rated companies. So the idea is that they are safer funds. Basically, you can invest in them, but like with most investing, high risk, high reward. And for something like this, it's generally considered lower risk, but also lower reward. One way to maybe conceptualize a money market fund is it can be a parking spot for some of your cash versus thinking of it as your long-term growth plan, like for your retirement. So the general upside with something like a money market fund is the fact that it is considered lower risk than other types of more volatile investments, which means you're less likely to lose your principal balance. A downside is, unlike a bank account where you would be parking your cash and storing your cash for later use, it's not FDIC insured. It's not a bank account, so it doesn't have that deposit insurance. Instead, it is an investment fund. So similar to many of the investments we've already talked about in this video, you would set up a brokerage account. Make sure you search for a money market fund, which is different from a money market account. This is where things start to get confusing because banks and investment companies like to make things confusing. So just make sure you're looking for the right thing. Last beginner investment I want to talk about on this list is called a REIT. Real Estate Investment Trust. So a REIT is a company that owns or finances real estate that produces income. Think about apartment complexes, warehouses, storage, etc. So basically this company is in the real estate business, and in order to make money from that business, they need investors. So the Real Estate Investment Trust is trying to make money out there because they have investors helping grow that money. The REITs have value, but they also pay out dividends. Dividends are when certain investments, like stocks and like REITs, specifically pay out amounts to their shareholders. Why people like REITs? A big reason is they like the real estate market, but it cuts out the need for having to deal with any tangible property. So it has a lower barrier to entry because rather than saving a bunch of money for a down payment on a particular property, you can be invested in everything that the REIT is invested in, and typically for lower amounts than you would need to buy real estate yourself. People also like it because of the dividends. Some people's investing strategies end up being based on income. How can I invest in so many things that pay out dividends or interest so that I have a regular income from those investments? And another reason people like it is it adds more diversification. It's another asset class that's different from stocks or bonds. So the more diversification you have, if one market is not doing well, you typically have the others to maintain your portfolio, as long as it's all tied to your approach and strategy. Downsides. Sometimes REITs can be volatile, just like the real estate market is. Hard to predict. And another thing, when you get paid out dividends, those can be taxable if you hold your REITs in regular brokerage accounts. For example, not a retirement account. The more dividends and interest you get paid, that could be taxable money. So how to get started is you would find an investment company or an account that allows you to purchase REITs. One way to approach it as a beginner is choosing a broad REIT. So this is now where we're putting multiple concepts together. There are REITs in the form of exchange traded funds. So rather than just investing in one building type or one company, an ETF can hold a bunch of different REITs. So now we're like an investment within an investment with another investment. So this is kind of how the investing world goes. They really be making up a bunch of stuff that you can buy with the hopes that it's going to go up in value. As a beginner investor, what I want you to do is to continue learning about these investments and how they gain value or lose value. What are they based on? Why is this something that even has value? In the meantime, you don't have to let that hold you up from starting, but longer term, as you build your wealth, you're gonna know more, you're gonna learn more, and you're gonna probably rely on financial professionals to help you out as well. All right, you made it to the end of the video. I told you guys at the beginning that after I give you the 6 options, I wanna give you some guidance on how to approach it. You might be like, okay, cool, I have 6 options. They all kind of make a little bit of sense, but which one should I start with? Or maybe some of you are like, okay, none of that made sense to me at all. I have no idea, I'm just gonna pick a random number. Here's a very simple decision framework because I think it's more important to start doing versus just putting it off. The things you want to consider: risk tolerance. Think about if you invested your first $500 and it looked like it dropped 20% tomorrow, meaning it went from 500 to 400. Would you panic and then sell it? Or would you just chill and keep your money in there and then maybe even start buying more because it's on sale? That's gonna help you start thinking about how much risk are you willing to take, and that can help determine which of those investments you should start with, right? We talked about different varying levels of risk. Number 2, something else to think about is your timeline, your time horizon. You want to make sure that what you invest in matches up with when you are going to want and need that money. These are all rules of thumb. It's gonna vary from situation, but for example, if you need money within the next month, you might want to keep that in a bank account. If you have a longer time horizon, you don't need to touch that money for years or decades. That might give you more flexibility to invest in markets that are more up and down. Finally, think about your system. What is your style? Do you want to DIY things? Do you want to be in the weeds? Do you want to learn as you make purchases of investments? Or do you want to autopilot the thing? Are you so overwhelmed by this that you just want to make sure you're starting? If so, that might be the Robo Advisor route. Or, I didn't mention it in this video, but it could also be the route of eventually getting a financial advisor. I know there are a lot of DIY people out there who feel strongly about, okay, don't pay a person, don't pay people for things you can do yourself. But I think if you want to build big wealth in the future, this is going to be something that comes up later. You're not going to want to DIY all of that, right? You'd rather have someone keeping an eye on things and helping you make those decisions who might have more training than you do. I hope this was helpful. Until next time, peace out.